All right, so now we're on module 8's assignments. This will be chapters 15 and 16, and those homework problems. So the first one here, we have a young software company. They need to raise 560,000. There's a venture capitalist that's going to provide cash in return for a 40% holding in the company. So this is like a Shark Tank, I think it's a television show, something like that. Yeah. So this person is going to step in, buy a portion of the company. And then the venture capitalist is going to hold 5,000 shares. The two entrepreneurs have a combined holding of 7,500. That's how they'll have the 40% ownership. And so what is the total after the money valuation of the firm? Right. So we know that 560,000 is 40%. So the whole thing must be 1.4 million. And then what do they place on each share? Again, we just have the 1.4 million divided by the 12,500 shares, right? And so that tells you how much that the venture capitalist is placing on those shares, because effectively he is saying the other person's shares are worth that. Okay, and then problem 2, you see there's like actually a series of questions, and so the answers for those are there on the right. Hopefully it makes sense, because what's going on is this company is going public, right? This initial public offering. So they're taking shares to the market. And so in this case, half of the shares are going to be sold and the other half go to the existing shareholders, those people that are in the ownership already, right? Because the company exists before it goes public, right? All those people that are at Google, when it goes public, now they have public Google stock. Okay, if the offering price was $56, the underwriters got a spread of 7%. The issue is heavily oversubscribed, and on the first day it shoots up to $151, right? So they probably have a very upset company. They're saying, why did you offer it at 56 if it's worth 3 times that, right? So what's the proceeds to the company? It's the number of shares, and then their price. What are the proceeds of the issues to the shareholders? The shareholders had their value, from it going. The same, because half of it was to the company and half of it was to the shareholders. And then what did the commission to the underwriters receive? But we know it's that 7%, right? So the number of shares times the offer. And then how much money was left on the table? Well, it's that difference, that 151 to 56, right? And then portion D, what's the cost of underwriting? That's what we the calculation is there, because you play the commission plus all this money left on the table. Okay, problem 3 from chapter 15. It's in 3 portions, so each of those are listed there. What's the average underpricing in this sample of IPOs? And you can just calculate what the price per share was, what the initial return was, and come up with what the average underpricing was. What's the average return of the portfolio from the 4 IPOs bid on when calculating the initial return? Remember to weight by the amount of money. So you see the shares allocated, you see the total investment, you see the return, and so you have your average initial return. Is this the winner's curse? It seems like yes, it is, right? You win, but by winning, you're not. So let me move on to number 4. Again, I apologize for my voice issues right now. So problem number 4, there's A through E. As you see, each of the answers are sort of the math behind them are explained there. But what's going on is they're going out they're having a rights issue at $10 for one new share for each 7 shares held. So they go into the existing shareholders and telling them, hey, you can get in this new one in this way. And so this is what's going on with this one. It's this new issue. And again, problem 5 is still doing the IPO issues. Right. And this one we're looking at, we could do a public issue, right, with the full underwriting and, go out, or we can do private placement, right, which we're end up paying a higher rate, but we don't have all those expenses associated with underwriting, right? And so you can see the proceeds of public placement or public issue versus private placement. And then the better if you were to calculate the present value of all of that extra interest, you'll see that you end up net better off with the public issue, even though you have those upfront expenses. The fact that you're saving it on those other later expenses on the higher interest, right? But again, notice that we're ignoring taxes. Because of taxes, it could make more sense actually to go back with a public issue. And then the last one in chapter 15, there's only 6 problems in this chapter, looks at this particular firm where we are proposing to sell 108 shares of its stock in an open auction. They go out and they see what shares are out there, right? And so if it is a discriminatory auction, then they're sold in blocks, based on what the price was, right? So what we end up doing is we say, okay, well, you guys are willing to pay 88, so we let you, and you're only willing to pay 86, so we let you. You're only willing to pay 81, so we let you, so on and so forth, until we account for all of the 108 thousand shares, right? So when you get down to 74, if you notice, we only take the 13,200 of those, even though they bid for 15,500, right? And in that case, that's what it looks like, and the money that we would get is higher. The uniform auction price is what you'll see a lot of times with these auctions, where it's what is the price that would clear the market, everybody gets that price. And it sounds like that ends up being bad for the seller, because you end up selling it at this lower price when there are some people that are willing to pay more. But what the research has shown is actually people are willing to bid more because they know that there's that probability that they're not going to pay what they bid, but they're going to pay a lower price, right? And this is how U.S. Treasuries are auctioned now. And so what we see is actually interest rates are lower than they otherwise would be because of that type of downward pressure, right? So even though the total receipts are down compared to if they did that discriminatory, over time it actually ends up being better for the seller. All right, so we'll go ahead and move on to chapter 16. Problems 1 and 2 are just using the price that we were doing before, only this time there's a couple of different dividends. And so we're going to have those discounted, at one rate, and then another rate if necessary. In this case, they're actually the same rate, but we can do that for a string of dividend payments, right? So in this case, the price is just the present value of those 2 future cash flows. And then problem 3 and 4 are just sort of definitional type of problems. And also for problems 5 and 6. Right? I know it seems like these are all going so fast, but we're about to enter some that are a little more complicated. So hopefully these are making sense what we're doing, though, because these are similar to what we've done earlier. Okay, so we're gonna jump right into problem 7 here. There's 2 portions to this, A and B. So they give us the companies, they tell us about their surplus cash and their fixed assets. They won a lawsuit and they're paid 2 million in cash, right? The market cap rises by that, right? And so it says, you know what, we're just going to pay it out to the shareholders by paying out $10 per share, right? So what happens to the stock price if the payout comes as a cash dividend? So if they were to just do that, um, then what happens? And so you see there on the right, we just add that 2 million in surplus cash. That drives up the total asset value to that 27 million. But then we have our dividend payout and our divided by our number of shares. So we calculate then what the stock price would need to be, right? And then what happens if it was a share repurchase? The stock price would actually be $27 instead of the 25, right? So what is the difference? Well, the difference is, did they pay it out in cash or not? If they kept it within the firm, then that stock price, right, is not going to show that this cash was paid out, because what they did was they were buying shares of stock, right? And so if you think about the number of shares of stock, right, they're actually going to be decreasing, right? And so that's why the stock price is going up. Where in the other one, we kept the same million shares of stock outstanding, right? So that's the difference there. Okay, problem 8, right? If you notice here, there's A, B, and C, right, to this one. So let's just start the very beginning. So you know, we have this company, they're paying a regular cash dividend. They're paying out all of its earnings and dividends, not expected to grow. And suppose that they say, hey, we're not paying cash dividends. What we're going to do is we're going to buy shares, right? And it shouldn't matter, right? Because all we're doing is we're just giving all of the cash back to shareholders. When we were paying a cash dividend, everybody got the same amount. In this way, you just decide, do I want to sell a share or not sell a share? If you don't sell a share, the value of your share goes up, like we saw in the last problem. And then if you sell your share, you get the cash, right? And so, uh, yeah, people are going to be indifferent if there isn't a difference, right? So that's kind of what's going on. How many shares will they repurchase, right? And then we'll do that calculation as we did before. And then what we'll see is, what does that mean for stock prices? And as you notice, under the old policy, the stock prices would stay the same, right? Under the new policy, that share price is going up, because instead of receiving a dividend, you're just receiving your value with an appreciation of the stock, right? So later on, when they're doing stock buyback, so they'll repurchase your shares, but they'll be doing it at a higher stock price, perhaps. Okay. Problem 9. Now we're doing House of Haddock instead of hors d'oeuvres, but I think we get hungry reading these problems. But yeah, they're making an announcement. Let's see, half of the cash is going to be in the form of dividends, and the remainder is in repurchasing stock. The repurchased stock would not be entitled to a dividend. And so as far as the valuation there for part A, right, then you see the pre-announcement value. Post-announcement, we know it's going to remain the same. And so you see that the value of the share would remain the same. Part B is a little more complicated, right? What's the expected stream of dividends per share from an investor who plans to retain his shares rather than sell them back, right? So for year 1, right, you see they're doing that repurchase, and you see what the dividend, right, how we calculate that, right, for year 1, right? And so you take the dividend at time 1 divided by the price at time 0 plus the growth rate, and that'll give you the overall return. And so the price at time 1, right, we calculate that based on the price at time 0 growing at that rate. Okay, and then we can calculate the number of shares we repurchase. So there'll be fewer shares the next year, right? The dividend gets split over the fewer shares. And then we do a repurchase, right? And again, we calculate what that dividend is plus that growth in there. And then we can calculate what that return is for that one, right? For that second period. So for the first one and then the second one, right? And the problem's not over. I got another slide, right? Feel free to pause if you need to, but I'm going to the next slide now, right? And so the price at times 2 is 1, and it's going to grow at that new rate, right? And that gives us the price at time 2. And then we're going to repurchase based on that price for the amount that we didn't pay in dividends. That tells us how many shares. So the number of shares will now step down again. And then we'll take the total dividend payment divided by our new number of shares, and then we'll get the dividend per share, which is higher still, right? And then you see in year 1 and in year 2 how the repurchase amount changes, how the discount rate changes, how the stock price is going up. You know, all of those changes going on. The number of shares is going down through these repurchases. Dividends are going up. And you see that what our dividend growth rate is, and then based on that, we can calculate the current price. So yeah, that part B was a bit more complicated. A was in 3 parts, but they were pretty simple. But then B, because we're looking at year-over-year cash flow changes, and the number of shares are changing in those periods as well, right? Okay, so moving on to question 10. And this one, I'll just have the answers on the next page. So, there's this 3 types of investors. There's individuals, corporations, and institutions. And they all have their different tax rates, right? Based on the type of holding that it is. Individuals invest this much in stock, corporations have this much, the remaining institutions. They all want to maximize after-tax incomes, right? And then these investors can choose from these different options. There's the low, medium, and high payout. You notice they're split between dividends and capital gains. Payouts are expected to persist in perpetuity because these are corporations we expect to survive. And then you see the total market value of each of those low, medium, and high payout, right? So question A is asking who's the marginal investor, right? And the marginal investor is the one that determines the price, right? Who's the one that's moving the needle, right? Suppose that this marginal group requires an after-tax return of 14%. What are the prices of those different stocks? So we know the payouts, right? If I require an after-tax return based on this marginal investors holding, what would that be? And then calculate the after-tax returns of the 3 types of stocks for each one, right? Because individuals and corporations and institutions are taxed differently. And then what are the dollar amounts held? Because we were told how much they put in. But let's look at the dollar amounts in each of those stocks between low, medium, and high, right? So the next page is going to be the answer. Feel free to pause here if you need, or of course you can go back and forth in the video. So the marginal investors are the institutions, and the institutions don't pay tax, right? They just said that in the previous problem. So the price of the low payout, you know, it will be the $30 divided by 14. The medium is 20 divided by 14, and the high is 32 divided by 14. Because you're looking at the total payout. And then for institutions, the after-tax return is 14% for each type of stock because that's what they're required, right? For individuals, what does it look like? Well, it's different because we're paying taxes, right, on those. The amount of taxes that we're paying, though, will differ based upon whether it's capital gains or dividends. You see C breaks it out for individuals and corporations. Again, institutions don't pay taxes, so their after-tax return is still the 14%. But yeah, for individual and corporations, and then D, how's that money split? Like we said, how individuals, how much they invest, and they're going to go into the low payout because that gives them the highest return, right? The 11.43%. Corporations are going to go into the high payout stock because that gives them the highest return, 12.6%, right? So all 10.6 billion goes there. And then institutions are basically indifferent, so they just fill out the rest. So that's hopefully clarifies everything for this last module. If you do have any questions or concerns, please don't hesitate to reach out to me and let me know. Thank you.